What's going on, guys? In this video, I'm going to show you how to make over 40% returns in a week on a single trade. Now, this trade that I'm going to show you is basically like a cheat code strategy that makes enormous amounts of money. I actually have this strategy playing out right now on Netflix, and I've been running this strategy for a very long time, especially when the markets are not doing that well. When they're going sideways or a little bit down, even if the market's a little bit bullish, this trade will still make you a lot of money. Now I'm going to show you a special kind of iron condor, which is fantastic for small portfolios. And I know a lot of you guys out there are trying to grow a small portfolio. So this video is for you. I'm going to show you a trade that's going to cost less than $500. Literally just a couple $100. And with this couple $100, you can have a 40% return per week, but only if you manage the trade and close it properly. But the good news is Uncle Henry is going to show you exactly how to open, manage, and close for a game. So if you appreciate me teaching you how to grow your small portfolio, then make sure to smash that like button and let's jump into it. So what I'm going to do is I'm actually going to use OptionsFi software. This is a software that I'm actually working on with a friend, and he has worked at a previous hedge fund with me. And this software right here basically gives you options to sell or buy based on an algorithm. So part of that algorithm, which I am familiar with, actually uses momentum factors and different factors that we were using during my time at the quant fund that I was working for. Now, what I want to do is I'm actually going to cheat and look at this call credit spread. So something I'm going to do is combine the call credit spread recommendations here with the put credit spreads if I find it on the same ticker, which I have. It's going to be NVIDIA. But real quick, check this out. So this software recommends call credit spreads, but it also does covered calls. If I scroll down, it does debit call spreads, debit put spreads, buy call options, sell put options, buy put options, and lastly, put credit spreads. What I'm going to do is I'm going to scroll back up and I'm going to look at NVIDIA for a call credit spread, and then I'm going to scroll down and pick NVIDIA for a put credit spread based on the recommendations. So right here, we have recommendation of 155 and 157.5. That is going to expire this Friday. But of course, if you're watching this in the future, you can just run the same strategy for 1 week out, or you can also get the software, which I will link in the description for you below. Now, let's open up NVIDIA. So NVIDIA, okay, I'm going to go to NVIDIA, and the first thing I'm going to do is I'm going to sell a call credit spread. Now, the reason I am going to do this is actually because the strategy of an iron condor makes money by selling both calls and puts. You're literally selling both sides, okay? So you're selling one and the other, and that's why this strategy can make so much money in a very short amount of time, because you're actually selling both sides. The stock can rise and it can fall, and you can still make money because this is a pretty neutral strategy. So check this out. NVIDIA is rising and it's coming back up, but it also has a very strong support, which is why I suspect OptionsFi algorithm is recommending both call credit spreads and put credit spreads, because this stock is somewhere in the middle of its range. So pulling up the options, I'm going to start with selling a call option. Now, the recommendation is to sell the 155. I'm going to verify and just take a look myself and see if I agree with that. So selling the 155, you would get $64 in premium collected. Now, if I expand this option, pretty interesting, it's a 0.13 delta, which is really low. Actually, very, very low. The lower the delta, the safer the option is to sell. That's because this delta right here of 0.13 means that there's a 13% chance that this option will expire in the money. And because we're selling an option, we really hope it does not expire in the money. Because if it does, then, we would incur a loss. So what we are looking for is a small delta. But keep in mind one thing, okay? The smaller the delta, the lower the premium. So if I go to 157.5, the delta is just 8.5, right? So although that is good, the chances of this expiring in the money are low, the premium is also lower than the 155 call option. So there's a trade-off. How close to the money do you go where the delta is higher and the risk is higher, but you make a lot of money? And how high do you go where the delta is really low, but the money is also really low? Well, actually, there's a sweet spot. For me, it's somewhere between 12 to 15 delta. So this recommendation of actually 155 is totally fine. However, because we are in a bear market and because tech stocks are not doing too well, I want to be just a little bit more aggressive. So NVIDIA is currently 142 per share, and I like this recommendation of 155, but I want to go a little bit lower and check out the 152.5. This is an 18 delta, so it's really close to my 15 delta that I roughly range for. So this is really close to the area that I like, and I'm going to be a little bit more aggressive with the call credit spread because, again, we are in a bear market in 2022, and I am not that bullish on tech stocks in the short term. So this strategy is a weekly strategy. Therefore, I don't really mind doing something 1 week out. It's really not that much time. So let's go ahead and sell this call option for 152.5. Now, again, I'm going to actually have to open up 4 different options because I'm going to be selling a call option and buying one, and then I'm going to be selling a put option and buying one. So let me explain. First, I'm selling the 152.5. Now, to create an iron condor, what I need to do is I also need to buy a call option. Now, the call option that was recommended for NVIDIA was about 157.5. So they're recommending basically a spread that is going to be $250. That's totally fine with me. I'm also going to do the same thing, except I'm not going to go for 157.5. I'm just going to go up by 1 to the 155. Because again, remember, it was supposed to be 155, 157, but I'm going to be a little bit more aggressive. That's what I like about the software. It's very conservative. It shows you how to make money. But sometimes I want to be more aggressive. I recommend getting the software and using it as a recommendation tool. You can use it as an idea generator where you find opportunities and then you can slightly tweak those opportunities based on your views. But the algorithm here is very strong and it uses multiple factors such as earning beat data, momentum scores, financial scores, analyst EPS, and much more. So now I have my call credit spread set up, okay? I've sold a call option and then I bought another call option. What I'm going to do now is I'm going to set up the put credit spread side because actually a call credit spread and a put credit spread combined is an iron condor. So what I'm going to do is I'm going to scroll down all the way to the bottom. This software actually gives 8 different strategies, but the strategy that I am looking for to create this iron condor is going to be the put credit spread. Now, if I scroll down, you can actually see that NVIDIA is again mentioned here. It's mentioning the 127 as a sell put and the 126 as a buy put, okay? Actually, I do want to look at the chart as well. I want to expand this right here. So I just wanted to expand the charts and I wanted to point out, you can see how the RSI is actually pretty high for NVIDIA. And again, this is more reason for me wanting to do the call credit spreads a little bit more aggressive. Because as you can see based on the chart here, it is actually a little bit out of the range, which means that NVIDIA is kind of expensive in the short term, especially in the last month. You can see here how October 13th wasn't really that bad, but in the last 2 to 3 weeks, this stock has had a run up. And that's because the stock was really depressed and really bad levels around 120. And now it has popped up to 140 per share. So this stock is getting a little bit hot and heated. So what I'm going to do is, again, I'm going to take a look at the 127 and 126 and see if I agree with the software or if I want to tweak it just a little bit. 127 sounds pretty good to me because the stock did bottom out right around the 120s area. And now it's at 142, so 127, let me take a look at it, is showing a 90% profit. So I really like this. This is going to mean that 9 out of 10 times you're going to win on this trade. If I expand this option, the delta is 0.09. That's really low. It makes sense that the software is going to recommend something even safer, like 0.09 delta, because we could see the stock retrace back down to the 130s or even a little bit lower. So the 127 strike is a really smart strike because again, the delta is very low, and this is going to be a 90% chance of profit. Now, something that I did notice here is that the implied volatility is 78. That's amazing. That's a really high implied volatility. That's another thing that the software does. It recommends high implied volatility stocks. It does a screening for you, so you don't have to put it in that much work. You can basically copy, paste, and win. Now, one thing I do want to mention is that managing this position, which I'm going to get into, is going to be a little bit difficult. Now, I wouldn't say it's that difficult, but there's a few things that you really need to know about managing an iron condor. But first, let me open up this position. So I'm going to go ahead and sell the 127, okay? I'm going to sell the 127, and now I'm going to buy. Now, the software is recommending that I buy the 126. However, what I want to do is I want to open up a little bit wider. The reason for it is the call credit spread side of things, right? The 152 and the 155 are $2.5 off. So I want to do something very similar. So what I'm going to do is I'm going to buy a put option that's going to be 3 strikes down, okay? The reason is because 127 minus 124 is $300, right around the same amount of the $250 I am putting up right here. So I'm going to sell the 124. Now this is going to be a very interesting iron condor. It's going to be slightly uneven, so this is an uneven iron condor that I am selling, and as you can see here, I'm making $59 and I'm risking $241. That is a 24% return in 5 days. Just 5 days is giving you a 24% return. Now, here's how you would actually manage this position. It's very important because check this out. An iron condor basically makes money so long as the stock stands within a certain range. Okay? As long as it's within a certain range, then you are good. You're not going to lose money. As soon as the stock goes crazy in one direction, then you can lose money on the downside. You can also lose money on the upside. An iron condor is really best for a stock that is pretty range bound or a stock that can fall or go up, but you want to make sure that you pick the correct strikes that are enough out of the money that this isn't really a problem. Now, that's easier said than done because what you want to do is you want to use technical analysis. You want to find what the top of the Bollinger Band is, the bottom of the Bollinger Band. There's many ways to figure out if a stock is low or high. By the way, if you want me to make a video on fundamental analysis, just shoot me a comment down below so I know that you guys want me to make that video. I'd be happy to do so. Now, what's going to happen is because these options are very out of the money, during the week, this stock will bounce up and down, right? It'll go somewhere down or maybe up, but typically it will not reach the break-even price. And if it doesn't, good. Now, if it does, you may want to start thinking about closing out this position. That's because the earlier you close out an iron condor, you don't really lose as much money as long as it doesn't go deep into one end or the other end. So in theory, you'll actually never lose the $241. That's what makes this return even higher because you are making about $59, you're risking $241. But in my experience, I've never actually lost the full amount of collateral that I put up for an iron condor because I will always close out that position as soon as it starts hitting the red zone, okay? And typically, if it does hit the red zone right around here, I will reevaluate my position. And if I no longer want to hold it, then I'm going to close out of that trade and I may incur a loss, but I'll never incur the full amount of loss. Now, I also want to point out that you can actually increase the rate of return that you're getting if you go a little bit riskier. So check this out. If I buy back the 124, and instead I buy the 125, I'm going to change my risk in return. Now my risk is even less, only 197, but my maximum return is $53. Now this right here is still giving you a really good max profit and the maximum loss is lower. So I do recommend playing around with strike prices, and what I typically do is I'll open up a few different strike prices, take a look at my break-even points. So right here, the bottom break-even point is 126.47. The top one is going to be 152 or actually 153.03. So again, the way to profitably make gains using iron condors is by having a stock that stays within this range and then managing this stock by watching it closely. And if the stock goes into the money, then typically what I do is I close out of that position and then I move on and I open up a new iron condor that is going to be either lower or higher. So what I mean by that is, for example, say that NVIDIA were to fall down to about $125, okay? That would be really low. So what I would do in this scenario is I would actually close out this position, right? Let's say I buy it back and I buy it back for $100, okay? So I end up losing about 50. So now again, I'm going to open up an iron condor, but now it's going to be much lower. So although these numbers are not going to be actual, I would go ahead and sell the 123. By the way, I'd be really aggressive if the stock fell that much. I would be very aggressive. So I would sell the 123, then I would buy the 121, and then I would go ahead and be very aggressive on the calls as well. And I would sell, for example, like the 127 for the calls and then buy the 129. This is how you would actually move down an iron condor. So as you can see now, it doesn't look like it makes much sense because the stock is around here. But if it were around here, then you would have a brand new iron condor that's going to be much lower. And basically, this is what some of the best traders in the world do when I was working at the New York Stock Exchange with professional traders, is when a position would move, they would again create a delta neutral position. So right here, you're pretty delta neutral, right? Because you are selling both the calls and the puts, so you are not looking for a specific direction. You think it's going to stay around the same price, so that's delta neutral. Now, if it goes down, it's going to be a completely different story, but if you close out the previous iron condor and open up a new one, you're again going to be in the middle here, and you're going to have another delta neutral position. As you can see here, this would actually be a really crazy max profit of over 10x. Now, the reason for that is because, again, it's a very low chance for this to go down all the way here. In fact, you can see how when I change the strike prices, the maximum profit here is insane because the chances are so low of this happening. But in this example right here, you can make a 10x return in just 1 week. But again, I would not use this type of position because, this type of position is pretty risky, and this would be a whole different video. But the point of this video is use iron condors to make a lot of money, use OptionsFi software to get your ideas, and then manage the position correctly, and you will likely see a lot of gains on a weekly basis or on a monthly basis. I would also trade options on a monthly basis. There's nothing wrong with that either. So I'm going to link optionsfi.com for you below, and I will see you guys in the next video.